Good morning and welcome to today's webcast, the Moss Adams Not-for-Profit Accounting and Auditing Update. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams. Lisa Todd, partner in our not-for-profit and higher education practice, and Sasha Correnti, senior manager in our not-for-profit and higher education practice. Lisa, I'll turn the line over to you to get us started.
Thank you, Pam. So we're going to kick it off today with our learning objectives. And here's what we want you to walk away with at the end of this session. You'll be able to plan your next steps to implementing ASU 2016-14. You'll be able to evaluate the impact of revenue recognition standards on contributions, understand changes to the disclosure requirements for fair value measurements, and understand the potential changes to accounting related to leases, cash flow presentation, and internal use software. To achieve those objectives, here's what our agenda looks like. We'll start today with going through ideas for implementation of the new not-for-profit presentation of financial statements, topic 958. Then we'll spend some time with an overview of ASU 2018-08, which is the Grants and Contracts for Not-for-Profit Entities standard. And they'll end today's session with an overview of some other recently issued standards and a couple of noteworthy items. So we're going to begin today by going over the not-for-profit presentation of financial statements, topic 958. And we're going to kick it off with a polling question, our first polling question today. So this first question is, how familiar are you with the not-for-profit presentation of financial statements, topic 958? Consider you an expert? You know enough to be dangerous? Maybe you've read a few insight articles, or you've ignored it in its entirety, hoping it'll go away. So I'll give you a few moments to respond and participate. Please click the button next to the answer to choose and hit Submit. We'll wait for the responses to come in here, and while we're doing that, just as a reminder, if you'd like to receive CPE credit for today's webcast, you'll need to respond to at least 3 of the 4 polling questions. I love that we've got almost 19% that have ignored it. So I'm hoping you'll definitely get something out of today. And looks like everyone, for the most part, does have some general knowledge about this new standard. Okay, so I want to start by talking about this presentation of the financial statements for not-for-profit and just give you a basic overview of the project objectives. So when the FASB took this project on several years ago, the thought was that this would be an update of the current model, and it's not meant to be a complete overhaul, but really an update to provide more useful information to those users of the not-for-profit financial statements and to really help our not-for-profits tell a better story regarding their financial story. And so again, you'll see that some of these changes are really meant to be more transparent for the user and really help present that good picture. So when is this new standard effective? Well, adoption is now upon us for those entities with calendar year ends. So the effective date is for fiscal years beginning after 12/15/2017. So that's for years ending December 31st, 2018, or for our June 30, 2019 year ends. And you can early adopt this pronouncement with some limitations, and we have seen that to date. When you're transitioning to this new ASU, you're going to want to apply all provisions of the new ASU in the year of adoption. And if you're presenting a comparative financial statements, for those comparative years presented, you're going to apply all provisions, except you can choose not to apply expenses by natural and functional analysis and the disclosures on liquidity and availability of resources to those prior periods presented. Just some important notes here. You may have already seen some of these provisions already adopted in the last year or so as this pronouncement came to be. And many of our not-for-profits are already permitted to incorporate many of these changes in the ASU without formally adopting. There are a few changes that are not allowed to be presented without formally adopting the ASU. And just so you're aware of those are presenting one class of restricted net assets, so consolidating that temporary and permanently restricted net asset classifications, underwater endowment accounting, eliminating disclosures of investment return components and netting expenses, and eliminating requirements to provide indirect reconciliation if you're using the direct method for operating cash flow presentation. So let's talk about these new requirements within the standard itself, and we're going to start with the net asset classes. The new standard addresses complexities in net asset reporting requirements by collapsing net asset classifications down from the 3 categories that you've seen in the past into 2. These new categories include with donor restriction, and these items represent net assets with donor restrictions, including underwater endowments. And then the second one is without donor restrictions. These represent net assets that aren't subject to donor restrictions, as well as voluntary reserves such as components of board-designated net assets. You'll see an example here of presentation of the statement of financial position. In addition to break out by these 2 net asset classes, not-for-profits may choose to disaggregate their information even further. So you'll see that the top item here shows the minimum requirement. breaking out net assets by without donor and with donor restriction. In the second example here, you'll see some further disaggregation. This includes both undesignated and board-designated items within the without donor restricted category, and the types of donor restricted items that are shown in the with donor restricted items. Regardless of the presentation that you use, there is a new requirement to disclose the amount, purpose, and type of board designations. And this can be done on the face of the financial statement or in the notes to the financial statement. This slide shows an example of how you might present the statement of activities under these two new asset classes. But keep in mind, this is not the only way the information can be presented, but a simplified example here. Current GAAP still does allow for flexibility in presentation, so it may make sense for you to disaggregate further your within the donor restricted column. You may want to show specific restrictions such as program restriction and endowment restriction, so you can add additional columns here if you feel that's necessary and useful. Some disclosures are required for each of these asset classes. For the net assets without donor restriction, you will need to disclose information about the amounts and purposes of board designations of net assets without donor restrictions. And you want to include all board designations, not only those related to board-designated endowments. For net assets with donor restrictions, you'll continue to disclose information about the nature and amounts of each of your donor-imposed restrictions, with a focus on both how and when those resources could be used, rather than as you do now with a bright line distinction between temporarily and permanently restrictions. Okay, so let's do another polling question to see where we are with adoption of this new standard. So did your organization early adopt the new standard? Yes, no, you don't know, or your guess is as good as mine, you're still hoping it will go away. So again, we'll give you a few moments to respond, and again, please click the button next to your answer and hit submit. And we'll give a few more seconds. Here we go. So looking at some of the responses, it looks like there are a few of you on here that have early adopted, and this is about what we're seeing with many of our clients. We've got a handful that have adopted, but the majority of participants still have not adopted this new standard. And that's why we're here today, to go through this. All right. So moving on to restrictions on property, plant, and equipment within this new standard. One of the provisions of this new standard is related specifically to restrictions for property, plant, and equipment. For the donations of or contributions restricted for the purchase of property, plant, and equipment, you can no longer imply a time restriction if it's not designated by the donor. And the new standard removes the option to release donor-imposed restrictions over the estimated life of the asset. The standard now requires you use the placed in service approach. You must report expirations of restrictions used to acquire or construct PP&E, and as you adopt, you'll want to reclassify amounts from net asset with donor restriction to without donor restriction at the beginning of the period of adoption, and that would be for those assets that are already placed in service. So remember, in the absence of explicit donor restrictions, Our not-for-profits now would be required to use the placed in service approach, and this is consistent with what currently is being done for healthcare not-for-profits who are already required to use this method. So let's talk about the new requirements for underwater endowments. Current GAAP is to disclose aggregate amounts by which funds are underwater. This new ASU requires you to classify the underwater amounts of donor-restricted endowment funds in net assets with donor restrictions. The update also requires disclosure of the aggregate fair value of the underwater funds, the original gift amount, or amount required to be maintained by the donor or by law, and also the governing body's policy and decisions made to spend or not to spend from such endowment funds during the year. So this is an example of how you might describe any underwater funds that you may have under this new requirement. So you'll see this disclosure states, from time to time, the fair value of assets associated with individual donor-restricted endowment funds may fall below the level that a donor or CUPMIFA requires for the not-for-profit to retain as a fund of perpetual duration. Deficiencies of this nature exist in 3 donor-restricted endowment funds, which together have an original gift value of $3,500, a current fair value of $3,300, and a deficiency of $200 as of June 30th. These deficiencies resulted from unfavorable market fluctuations that occurred shortly after the investment of new contributions for donor-restricted endowment funds, and continued appropriation for certain programs that was deemed prudent by the Board of Trustees. So you'll see here the original gift amount of the underwater endowment is disclosed, along with the fair value and the deficient amount, as well as the spending policy that continued by the board. Moving on to liquidity and availability, and I will have to say of all of the provisions of this new not-for-profit financial reporting standard, this is probably the one that we get the most questions on. So I'm happy to talk to you a little bit more about what this requirement is. The new ASU requires you to now disclose information specifically on liquidity and your availability of assets. So you're now required to disclose qualitative information on how your organization manages its liquid resources, as well as disclose quantitative and qualitative information that communicates the availability of your organization's current financial assets at the statement of financial position date to meet near-term cash needs for your general expenditures. So looking at qualitative information, so how do you want to go about creating content for your qualitative information disclosure? You'll want information that's useful in assessing your entity's liquidity and that communicates how your not-for-profit manages your liquid resources that are available to meet your cash needs for general expenditure within 1 year of the date of the statement of financial position. So to do this, you may want to include specific information by reviewing your formal policy for managing your organization's liquidity needs, and consider specifically discussing in this the potential removal of any board-designated assets in the near future, any access that your organization has to specific lines of credit that could be drawn upon, or any other items that might be useful to the reader of the financial statement. Here's an example of what you might include regarding qualitative information. In this footnote, it states specifically that the not-for-profit has a goal to maintain financial assets which consist of cash and short-term investments on hand to meet 60 days of normal operating expenses, which are on the average approximately $3 million. As part of its liquidity management, Not-for-profit A invests cash in excess of daily requirements in various short-term investments, including certificates of deposit and short-term treasury instruments. In addition, Not-for-profit A has $2.5 million in line of credit that is available in the event of an unexpected liquidity event. Along with the qualitative information, you will also include quantitative information either on the face of the statement of financial position or in the notes that communicate the availability of a not-for-profit's financial assets at the date of the statement of financial position to meet your cash needs for general expenditure within 1 year of that date. So keep in mind, availability of financial assets could be affected by the nature of the asset, external limits imposed by donors, laws, or contracts with others, and internal limits imposed by governing board decisions. You'll also need to decide the format of this presentation, so gross versus net. Let's look at an example of that. So here is an example of a disclosure in which the entity begins with disclosing all financial assets. So this ties back to that statement of financial position. And then you'll see that they're removing those assets that are unavailable for general expenditure in the next year. So we start with $98 million and then reduce those assets for such items as investments held in trust with others, long-term receivables, endowments, and board-designated endowments. So these are all assets that are not available to the organization in the next 12 months. You'll see then we get down to the financial assets available to meet those cash needs for general expenditure within 1 year of $29 million. Here's another example, and this is a very simple example, where the entity is simply providing those assets available within 1 year for use. So you'll see you've got your cash, your short-term receivables, contributions that will be received for general operations within the next year, any payouts on your quasi-endowment, as well as investments that are not encumbered or restricted for other purposes to get your total. Now we're going to move on to expense reporting, and I'm going to turn it over to Sasha.
Thanks, Lisa. So let's spend a few more minutes talking through the remainder of the not-for-profit reporting standard, covering expenses, investments, cash flow, and then actual implementation. Under the new standard, there are expanded requirements related to expenses. There is now a requirement for all not-for-profit entities to present an analysis of expenses by both function and natural classification. Previously, this requirement only existed for voluntary health and welfare organizations, but has now been expanded to all entities. Luckily, the standard did not specify a specific presentation location, but did provide a few options for presentation, such as in the footnotes, in a separate statement, such as the Statement of Functional Expenses, or in the Statement of Activities. Presenting as a supplemental schedule is not an acceptable presentation to meet the standard. Additional disclosures will also be required relating to the methods used to allocate costs among functions. The intent of this requirement is to provide additional useful information to users of the not-for-profit entity's financial statements and help them assess the link between the nature of expenses and their relation to program and support activities, the proportion of expenses that are fixed versus discretionary, the allocation method used in allocating expenses among functions, and the cost incurred to provide services. Activities that represent direct conduct or direct supervision of programs or other supporting activities will require allocation for management and general activities. Here is one example of how the presentation requirements could be accomplished. This is showing the natural categories on the left, and on the top you can see the functional categories. The level of detail in terms of how many programs are reported is up to the not-for-profit entity. Here is yet another example of how the reporting requirements could be met. This is likely an example that could be baked into the statement of activities or into the footnotes themselves. The nice thing is there are options, so this is a great opportunity for the not-for-profit entity to discuss what they feel users of the financial statements would find most relevant. Next steps. Now it's time to have some conversations internally and potentially even with board members and determine, where do you plan to present this information? Is it going to be the statement of activities, separate schedule, or footnotes? What level of detail do you want to present? The minimum requirements, or do you think more detail would be helpful to the readers? Assess the current methods being used. Are there any changes that should be made? This is a great time to do it. Ensure you formalize your allocation methods and document it. Consider whether approval by the board or other committee is necessary. Might as well draft the methods used footnote at this time. You can pull information directly from your documented policy. Let's shift from expenses to investment return. Under the previous standard, there was a lack of consistency in the presentation of investment return and expenses on the statement of activities. Not-for-profit entities were also required to disclose investment expenses on the face or in the notes to the financial statements. This led to a lack of comparability between organizations. So what's changed with presentation of investment return? Organizations will now present investment return net of related investment expenses, which will include external and direct internal investment expenses on the statement of activities. In addition, the standard no longer requires organizations to disclose gross investment income and related expenses in the footnotes. It should be noted that this guidance does not apply to programmatic investments. The last component of the new not-for-profit reporting standard we are going to address today before thinking about next steps is the statement of cash flows. And this really is one of the easier ones. Really, the only change to address here is the fact that if an organization is using the direct method, they are no longer required to also present or disclose the indirect method reconciliation. Organizations are still allowed to choose which method they want to use, the direct or indirect. Next steps. What can you do now and as you implement the new not-for-profit reporting standard? Number one, use our guide. We have sent this out electronically, but if you haven't received it, please reach out and we will ensure it gets forwarded to you. The guide does a great job of summarizing the changes and also providing an implementation checklist that can be used. Number two, this is a great opportunity for the organization to inventory and evaluate policies and procedures. Anything that should be changed or updated, this is an excellent time to make this happen and also ensure all such policies and processes are documented. Three, always great to assign roles and to ensure you have someone in place to spearhead this process. Likely, that will be most of the people attending this webcast today, but it's also a great time to communicate with the board and ensure they understand what is going on and that they are also on board with any changes being considered. Lastly, revisit the story your organization is trying to tell with the financial statements. Any changes that can be made to make the story more clear or impactful? Please remember that we are always here to help, and we will continue to provide insight on the new requirements as well as implementation suggestions. Okay, now let's take a quick break for a polling question. Which of the components of the new standard will be most challenging to implement? Net assets, expenses, liquidity and availability, or all of the above? Please take a moment to answer the question so that you can ensure you receive your full CPE. We will give everyone a minute to get their answers locked in. For those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. I'll give everyone a few more seconds. So it looks like it's pretty split actually, but liquidity and availability coming out as the leader, which, as Lisa mentioned, we are not surprised about, and what we are seeing as we've been talking to people out in industry as well. Okay, now we get to shift gears away from the not-for-profit reporting standard and to ASU 2018-08 related to grants and contracts. Let's start with a little background on how this standard came to be. ASU 2014-09, the revenue recognition standard, raised questions as to whether grants and contracts are in scope of that guidance, addressing reciprocal versus non-reciprocal. ASU 2014-09, Revenue from Contracts with Customers, was issued in May 2014 and is the result of a convergence effort between FASB and the International Accounting Standard Board. It took standard setters nearly 10 years to develop the final standard. It should be noted not all revenue sources are impacted. Revenue from contributions and investment income, both of these revenue streams, have been scoped out of the new revenue standard. A contribution is voluntary and non-reciprocal and thus scoped out. Contracts that have both an exchange and contribution component would need to be evaluated and the exchange component analyzed under the new revenue recognition guidance. Continuing with a few more pieces of background information, exchange transactions are defined as reciprocal transfer between two entities acquiring assets or services or satisfying liabilities by surrendering other assets or services or incurring other obligations. Examples would include tuition payments received by a school or admission fees received by an art museum. As mentioned previously, scoped out are the non-exchange transactions or contributions. ASU 2018-08 applies to all entities, including both not-for-profits and business entities, that receive or make contributions unless otherwise indicated. ASU 2018-08 excludes transfers of assets from the government to business entities. The standard applies to both contributions received by a recipient and contributions made by a resource provider. The intent is that both apply the same guidance. The entities do not need to track each other's accounting to achieve the same reporting results. It is important to note that the term used in the financial statement presentation to label revenue, for example, contribution, grant, donation, is not a factor for determining whether an agreement is within the scope of that guidance. Okay, here's yet another polling question. What type of impact are you expecting the revenue recognition standard to have on your organization? No impact at all. We have a couple of revenue streams we need to review. We have a number of different streams of income to evaluate. Or I don't know. Take a few minutes, click the button, and then hit Submit. And then we'll take a look at the responses. As was noted in the opening video at the beginning, once you have completed all CPE requirements today, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. Take a few more seconds and we'll go ahead and advance to the results. So pretty spread out, but it looks like the majority do have a few revenue streams that will need to be reviewed, so the information today will be useful in helping start that conversation. Despite existing guidance, there is significant diversity in practice on how grants and contracts are recognized by not-for-profits. While this has been a long-standing issue, the new revenue guidance has placed a renewed focus on it. Some organizations account for grants and contracts as non-reciprocal transactions, like a contribution, and some not-for-profits account for these as reciprocal or exchange transactions. Stakeholders have also expressed difficulty in distinguishing between a condition and a restriction. There is diversity in practice in determining whether the likelihood of failing to meet a condition is remote, which can ultimately change when revenue is recognized. Overall, these occur from various types of funders, but government grants and contracts seem to have the most concern among organizations. The proposed ASU notes the following: a resource provider is not synonymous with the general public. Indirect benefit received by the public as a result of the assets transferred is not equivalent to commensurate value received by the resource provider. Execution of a resource provider's mission or the positive sentiment from acting as a donor would not constitute commensurate value received by a resource provider for purposes of determining whether a transfer of assets is a contribution or an exchange. Now let's talk a little in more detail about reciprocal or exchange versus non-reciprocal, the non-exchange contribution transactions. First, you need to consider who is receiving the benefit. Under current practice, an exchange transaction is one in which direct commensurate value is provided. Under new revenue recognition standard, it's clarified that the direct commensurate value is provided to the resource provider, and it clarifies who would be considered a third party. For exchange transactions, entities will need to follow the new revenue recognition standard ASU 2014-09. ASU 2014-09 clarified that non-exchange transactions will follow contribution accounting under Topic 958-605. Now, with ASU 2018-08, Topic 958 was further clarified. It adds paragraphs that help to clarify the scope of the subtopic as well as illustrative examples. As previously mentioned, the resource provider is not synonymous with the general public, even a governmental entity. If a resource provider receives value indirectly by providing a societal benefit, this would be considered a non-reciprocal transaction. If the primary beneficiary of a grant or contract is a third party, a not-for-profit must use judgment to determine if the transaction is reciprocal or non-reciprocal. Further, a resource provider's mission or feel-good sentiment does not constitute commensurate value received. The type of resource provider should not override the substance of the transaction. Let's talk now about conditional versus unconditional. For a donor-imposed condition to exist under the new ASU, a right of return or release must exist and the agreement must include a barrier. The standard does provide indicators and examples to help in the determination. Indicators to determine a barrier. To determine what is a barrier, a not-for-profit will consider indicators, which will include, but are not limited to, the following: the inclusion of a measurable performance-related barrier or other measurable barrier, the extent to which a stipulation limits discretion by the recipient on the conduct of an activity, the extent to which a stipulation is related to the purpose of the agreement. Here is a nice flowchart that will help in assessing whether a transaction is a non-reciprocal transaction or an exchange transaction. If resource provider is not receiving direct value for the resources provided, the transaction will be considered a contribution, unless it can be shown that the resource provider is making the payment on behalf of an existing exchange transaction between the not-for-profit entity and an identified customer. I encourage everyone to be familiar with this flowchart as well as the one on the next slide I'm about to show. Now here's a flowchart addressing whether conditions are present. The ASU provides guidance on whether a contribution is conditional or unconditional. This decision is based on whether a barrier that must be overcome and either a right of return of assets transferred or a right of release of a promisor's obligation to transfer assets is determinable from the agreement. The presence of both a barrier and a right of return or a right of release indicates that a recipient not-for-profit entity is not entitled to the transfer assets until it has overcome the barriers in the agreement. Prior to overcoming those barriers, the contribution would be considered conditional. After a contribution has been deemed unconditional, an entity would then consider whether the contribution is restricted on the basis of current definition of the term donor-imposed restriction, which includes a consideration of how broad or narrow the purpose of the agreement is and whether the resources are available for use only after a specified date. The FASB believes that the proposed ASU could result in more grants and contracts being accounted for as contributions, although conditional contributions, than under current GAAP. For this reason, clarifying the guidance about whether a contribution is conditional or unconditional is important because such classification impacts the timing of when the contribution is recognized for revenue purposes. It's likely there will be impact on funding that is received from government agencies, individuals, and corporations and foundations. The simultaneous release option allows a not-for-profit to recognize a restricted contribution directly in unrestricted net assets or net assets without donor restrictions if the restriction is met in the same period that the revenue is recognized. This election must be applied consistently to all restricted contributions and investment returns. There are disclosures that are required. You want to ensure you have all of the disclosures covered in your notes to your financial statements. As you can see, there are a few pieces. In the spirit of time, I'm not going to cover these, but if you download the slide deck, you'll want to read them. The amendments in this update should be applied on a modified prospective basis. Retrospective application is permitted. Under a modified prospective basis, in the first set of financial statements following the effective date, the amendments should be applied to agreements that are either not completed as of the effective date or have been entered into after the effective date. The effective date for public business entities or a not-for-profit that has issued or is a conduit bond obligor for securities that are traded, listed, or quoted on an exchange or over-the-counter market, the amendments should be applied to annual periods beginning after June 15, 2018. So that would be now. All other entities should apply the amendments for transactions in which the entity serves as the resource recipient to annual periods beginning after December 15, 2018. So that would be December 31st, 2019 and June 30, 2020. Early adoption of the amendments is permitted. As mentioned, this was intended to be a high-level introduction to some of the changes. As implementation occurs, we will continue to evaluate and communicate important details in what we are learning and what we are seeing out in the industry. Lisa, I'll now pass things back over to you to take us across the finish line.
Thanks, Sasha. I'd like to spend the end of our session today just walking through a few other noteworthy items that everyone should be aware of. And I'm going to start by talking about fair value measurements. This is a new standard that was issued a few months ago in August, and the FASB released this ASU 2018-13 related to fair value measurements, providing changes to the disclosure requirements for fair value measurements. This ASU eliminates disclosures the FASB felt relied too heavily on subjective information that could be misinterpreted. and it strengthens remaining disclosures to provide increased transparency for the estimates and assumptions used in valuation. This is exciting because it's rare that we get to say that certain items have been eliminated with an ASU, but this is the case with this particular ASU. So going through the disclosure requirements that have been removed, you're no longer required to disclose the amount of and reasons for transfers between level 1 and 2 of the fair value hierarchy. You're also no longer required to disclose the timing policy for transfers between levels. Under the current guidance, an entity is required to disclose and follow a consistent policy for timing of transfers between fair value levels, so the event date, beginning or end of a period, etc. Now, an entity must still apply a consistent policy for the timing of transfers, but now you're no longer specifically required to disclose that policy. You're also no longer required to disclose the valuation process for Level 3 fair value measurements. And for non-public entity, the change in unrealized gains and losses for the period, including earnings for Level 3 recurring measurements held at the end of the reporting period, are no longer required to be disclosed. So let's talk about the modifications that this standard has. So the following disclosure requirements are modified with this new ASU. Non-public entities are no longer required to prepare a roll forward for Level 3 investments. However, they will be required to disclose transfers into and out of Level 3 and purchases and issues of Level 3 assets. With this ASU, there's also clarification on the measurement uncertainty disclosure. And the measurement uncertainty disclosure relates to uncertainty in measurement as of the reporting date rather than sensitivity to changes in the future. This new disclosure intends to convey measurement uncertainty because of the use of unobservable inputs that reasonably could have been different at the reporting date, rather than sensitivity to expected future changes. In addition, this ASU modifies investments related to net asset value. So for those investments in entities that calculate net asset value, entity will be required to disclose the estimated timing of liquidation of an investee's assets and the date when redemption restrictions might lapse only if the investee has communicated that information to the reporting entity or announced that timing publicly. So when is this fair value measurement ASU effective? Well, these new amendments are effective for all entities for interim and annual reporting periods beginning after December 15th, 2019. So that'd be for our 2020 calendar year ends. Early adoption is permitted for all entities. An entity is permitted to early adopt any removed or modified disclosures upon issuance of this ASU for which financial statements have not yet been issued or made available for issuance, and delay adoption of the additional disclosures until their effective date. These amendments should be applied prospectively for disclosure of the changes in unrealized gains and losses, the range and the weighted average used to develop significant unobservable inputs for Level 3 instruments, and the narrative description of that measurement uncertainty disclosure. All other changes should be applied retrospectively. Moving on from fair value to another new standard that we wanted to mention, which relates to intangibles and internal use software, ASU 2018-15. This ASU addresses the accounting for implementation costs paid by a customer in a cloud computing arrangement, and we're seeing more and more of this happening where this is a very common situation with most entities. So under this new standard, implementation costs incurred in a hosting arrangement that's a service contract should be accounted for in the same manner as implementation costs associated with developing or obtaining internal use software. While an entity would generally expense costs incurred during the preliminary project and post-implementation stages, as well as data conversion and training, the costs associated with the application development phase would generally be capitalized. This ASU is effective at different times based on an entity's classification. So for public entities, effective for annual periods beginning after December 15th, 2019, including interim periods within that period. And for all other entities, those non-public entities, it's effective for annual periods beginning after December 15th, 2020, and interim periods within annual periods beginning after December 15th, 2021. And early adoption is permitted for this standard. Another topic we wanted to mention today relates to cryptocurrency. And this is a hot topic, so we thought it worth mentioning today. Cryptocurrency includes digital assets such as Bitcoin, and we are seeing a lot of activity in this area, and many nonprofits are being approached with gifts of this nature. So there's a few things that you really need to keep in mind in relation to cryptocurrency. First of all, there's no specific conclusion from the FASB on the classification of cryptocurrency. Many in practice today are determining that cryptocurrency is not cash or currency or even a financial asset, but rather are accounting and classifying this as an indefinite-lived intangible asset. However, I want to make it clear we are still waiting official guidance on this matter from the FASB, and so there is no official guidance clarifying that classification. There's some things, though, that you really need to consider as an organization prior to accepting cryptocurrency. And one of those things you might want to do is looking at your gift policy. So it's probably time to review your organization's gift and investment policy specifically to address cryptocurrency. You may need to provide training to both management and your staff, including your development team, specifically regarding cryptocurrency and what those policies are. If you hold cryptocurrency, you probably need to revisit your internal control policies and procedures to address valuation and monitoring and processing of cryptocurrency. And as you do that, some things to consider would be looking at the type of wallet that the cryptocurrency is held in and who might have access to the digital key for that currency, including thinking about segregation of duties when you're looking at that. Things such as, do you need a two-step verification process for that? You also need to look at what your valuation technique is going to be used for valuing that cryptocurrency at each reporting period and any applicable financial statement disclosures that will be needed around that currency. I want to strongly encourage you, if you have any holdings of cryptocurrency or you think you might be receiving a gift of this nature, especially if it is significant in size, you really need to consult early with your accounting service provider or your auditor. The reason being is that audit procedures that must be performed around determining completeness, existence, right of ownership, along with the valuation of that asset can deem to be very complex and difficult. And so again, consultation early is just going to help that process. Switching gears to leases, topic 842. This is a standard that has been around now for a while and is part of that convergence of the international reporting standards and US GAAP that happened alongside the revenue recognition standard. Under this new standard, a lessee will be required to recognize assets and liabilities for leases with lease terms greater than 12 months, and a lessee should recognize in the statement of financial position a liability to make lease payments, the lease liability, and the right to use asset, which represents its right to use of the underlying asset for that lease term. There continues under this standard to be a differentiation between finance leases and operating leases. As far as effective dates, for this standard for public companies, this is beginning for fiscal years after December 15th, 2018, so for the calendar year 2019. And for all other entities, fiscal years beginning after December 15th, 2019, so those calendar years 2020. And early adoption is permitted for all organizations. Our last topic here relates to a new ASU that was issued in 2016, ASU 2016-18, and this relates to the statement of cash flow and specifically restricted cash. Under this new ASU, organizations will now be required to show the changes in cash, cash equivalents, restricted cash, and restricted cash equivalents in the statement of cash flow totals. When cash and cash equivalents are in more than one line item on the statement of financial position, a reconciliation of the totals in the statement of cash flow related to those captions is now required. For public companies, the standard is effective for December 31st, 2018 or for June 30, 2019 year ends. And for non-public companies, the standard is effective for December 31st, 2019 or June 30, 2020 year ends. And early adoption is permitted. Because the standard is reconciling your restricted cash back to your statement of financial position, I have seen many entities already begin to early adopt this pronouncement. It's fairly simple, and it actually provides a nice disclosure for the users of the financial statements. All right, I'm now going to turn it back over to Pam for our Q&A period.
Thank you, Lisa and Sasha. We've got probably about 4 minutes left here. Probably just have time to take a question or two. We do have several questions that we've received, and please don't worry if you submitted something and we don't get to it today. We will be following up by email. Sasha, I'm wondering if you can address this question. The question that was received is, what is the entry on the books of the donor if a contribution is determined to be conditional?
Yes, Pam, that's a great question. And if the contribution is considered to be conditional, it will be required that is disclosed in the notes to the financial statements. However, there is no entry on the books until the condition is met. So once the contribution becomes unconditional, at that point in time, there would be an entry on the books. However, disclosure is required. And that can be a bit of a challenge internally because you will be receiving items that you will need to be tracking. However, you will not necessarily be recording them to the general ledger. So it's a good time to come up with a good internal process, if you don't already have one, as to how all of that information will be gathered and tracked.
Thank you, Sasha. And again, like I mentioned, we received several questions. I'm not sure that we'll be able to get to them today. Also, we did receive several inquiries from several of you regarding copies or links to the NFP implementation guide. I think we've tried to reach out to as many of you with a link to the guide, but please know that we will be sending an email, follow-up email after this webcast with a link to the implementation guide and where you can download that. So more to come on that. We're also recording today's webcast. I know a couple of people had some technical difficulties, but know that you'll be able to replay today's recording as well. So again, thank you to Lisa and Sasha for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE Progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will also be emailed to you probably within 2 weeks, and should you have any difficulty downloading that now. Additionally, we hope here is a link to a survey where you can provide feedback for today's presentation. Please take a moment to complete this, as your feedback is very important to us. Thank you again for joining us, and we hope you'll join us again next time.